This is the FM Gold channel of All India Radio. In the program News Analysis, now we bring you a discussion on RBI's monetary policy. The participants are A.K. Gupta, Director, Bankers Training Institute, and Dr. Maharaj Krishan Bhatt, Principal, Maharaja Agrasen Institute of Management Studies.
Mr. A.K. Gupta, first I would like to know from you is that the repo rate has been raised by 0.25%. What it means?
Over a period of time, a repo rate has become a reference rate to give a signal the way the rate of interest are likely to go in the market. Increase in repo rate by 25 basis points is an indication that cost of borrowing may in fact increase slightly. This is also a signal that rate of interest are not likely to come down in the near term, as we were expecting couple of days back with the arrival of Dr. Rajan as the Governor of RBI.
It means that house loans, car loans and other such loans will be costly in the market. What will be its impact on the common man who is already reeling under high inflation?
Question is that certainly it's a signal for increase in interest rates, and if I put it otherwise, it's a signal that interest rates are not likely to go down. I don't expect that in near future and immediately the rate of interest are likely to rise on housing loans or auto loans. There is enough competition in the market. State Bank of India, for example, is still maintaining interest rates on housing loan at somewhere around 9.95%, which it had almost a year back. So with that kind of the competition among banks, I don't perceive any further rise, but at the same time, I don't perceive any downfall immediately. One. Secondly, as far as the common man is concerned and the inflation is concerned, the interest rates and the inflation have a relationship with each other, and that is precisely the reason, if you look at the figures announced in the last week, inflation rate has again gone up beyond 6%. RBI's projection is that they want to bring it down to less than 5%. Inflation as measured in terms of the wholesale price index. Given that situation, I think RBI governor did not have many options to reduce the interest rates.
If I see it this way, that RBI governor had an option to think in terms of growth or inflation, and he has selected only inflation containment as the prime duty. How do you react to this thing?
RBI governor has made it very clear that their focus is both growth and inflation. And it's a misnomer, in fact, when we always say that high interest rates will reduce the growth dramatically. The first and most important thing for any central bank in the world is to control inflation. Once the inflation rate stabilizes, it gives a stimulus to the industry. It gives a stimulus to various other factors, which in result may help in the growth. And as Dr. Rajan has made it very clear that RBI's comfort level for inflation is 5% based on wholesale price index, and simultaneously there are some couple of other steps which would be taken towards the growth rate. Another thing, growth depends not only on the interest rates, it depends on the policy decisions, it depends on the status of the infrastructure in a country, it depends on the demand, it depends on the surplus money available with the people. So I would agree that yes, the focus has been inflation, but what he says that I'm not losing sight of the growth as well.
But I would like to put it in a different perspective. You have seen that market today has reacted with a sharp decline in the share prices. The market overall has not given an overwhelming response to what the steps taken by the RBI governor. This means that the share market has taken not in a correct manner. How do you react to it?
Share market is volatile. It changes every day. Yesterday, it had gone up by more than 600 points. People were expecting that Mr. Rajan would be reducing the interest rates. That expectation has not come true. So as a result, the market was expected to react that way as soon as the increase in the repo rate was announced.
While I was listening to the Raghuram Rajan, he said that fiscal deficit will be improved by improvement in international conditions. How you see to this statement? Is it that improvement in Europe, improvement in UK or Japan will influence directly our fiscal deficits? Or is it that fiscal measures should have been taken to do betterment in the reduction of fiscal deficits?
Question is, managing the fiscal deficit is the business of the government and not the RBI. What he is referring to is, you see, how the position of the rupee has changed vis-a-vis dollar over last almost 10-15 days. The rupee is hovering around between 61 to 62 now. As a result, the import bills will go down. As a result, current account deficit will reduce. Secondly, in the last 4 days, due to steps taken by RBI, there has been an inflow of foreign exchange to the extent of 1.4 billion. These are indications towards improvement in the position of the current account deficit, which RBI certainly trying to target at. Secondly, exports are increasing. The interest subventions have been given. With this also, current account deficit is likely to remain within manageable limits.
I see sometimes in a different perspective that Mr. Raghuram Rajan has only prolonged the policy of the earlier RBI governor. He has not shifted something new what was expected this time. At least share market or those in the business were expecting some concrete steps which were not taken. How do you react to it?
The policy is framed over a period of time in a calibrated manner, considering the basic objective, and in the last decade, RBI has consistently maintained that RBI's policy is to check inflation along with growth, making funds available to productive sectors of economy at a reasonable rate. With these three focus in mind, before any governor, if inflation is increasing, anybody in place of Dr. Rajan would have taken similar steps if inflation is at this level. Had inflation slowed down, certainly there would have been a scope for reduction in the interest rate. Secondly, normally we consider inflation based on the wholesale price index, but Dr. Rajan has said that inflation based on consumer price index will also be considered. That also will be a benchmark for any policy decisions. When inflation rate is so high, I think reducing the interest rate, making funds available at cheaper rates, making funds available for further holding, or reducing the cost of holding could have been a difficult situation as far as inflation and growth are concerned.
This step will only reduce the consumer price index because inflation in that sector was going beyond limits. It's a direct attack on inflation, and I don't feel it has anything to do with the growth rate. How you see to it?
The call a central bank has to take whether they give more importance to checking inflation or they give more importance to growth. It is inflation which hits the common man most. So any central bank first tries to put a check on inflation and simultaneously tries to ensure whatever is best possible in a given situation in terms of calibrating the interest rates, which people believe that is a lever for growth, which I don't think so is the only lever available for growth. Every time we talk about interest rates as a stimulus for growth, there are many other aspects for growth which has to be looked into, and as inflation stabilizes, interest rates can also prove to be an instrument towards growth.
So far as you are talking that majority will be influenced by inflation, it's not only actually inflation, it's also job problem, it is also low investment, which is equally influencing the common man. RBI could have come out with certain concession in repo rate, that way allowed free flow of funds and may have given a lease of life to the industrial setup. Do you feel it is like that?
Repo rate is a rate at which banks borrow from RBI. If there is a problem of liquidity, the rate at which banks borrow from RBI has been increased by 25 basis points. RBI governor has reduced the minimum holding per day from 99% to 95% of daily CRR requirement, which will give a leeway to the banks to manage their funds better, to manage their liquidity better.
If I put it this way, that there seems to be a confusion in the policy. On the one side, the finance minister says that the prime problem before the country is reduction of fiscal deficit. On the other hand, RBI is saying that the prime problem with the economy is reduction of inflation. Are the two going in two different directions, or both of them attacking the same problem?
Fiscal deficit is a concern both from the government as well as for RBI. Fiscal deficit to be reduced when you spend less, when you earn more. Government has put a curb on spending by the government departments. No fresh jobs to be created. Certain controllable expenditures to be reduced as far as possible as a step towards fiscal consolidation. Reducing inflation and fiscal deficit are not contradictory to each other. I can agree that yes, interest rates do affect the growth, but interest rates increase is not likely to increase fiscal deficit. Fiscal deficit, government is already taking enough steps to keep it within manageable limits.
Earlier there was a confusion and it led to divergent views between Finance Minister and Mr. Subbarao, the earlier RBI Governor. This time, let's hope that things may not culminate in the same direction. There was a reduction in marginal standing facility by 75 points from 10.25% to 9.5%. What will be its immediate effect?
Marginal standing facility is in the shape of that if you are not able to maintain statutory liquidity ratio of 23%, you are required to pay huge penalty to RBI. Up to 2%, banks are allowed. That if your SLR is less than 23%, then RBI will not impose penalty. You may take funds from RBI at marginal standing facility rate. To that extent, liquidity of the banks would increase. If some bank is not able to maintain SLR at 23%, it can borrow from RBI at a relatively cheaper rate. The cost of the borrowing from RBI through marginal standing facility will reduce substantially.
Summing up the whole issue, how do you feel that these steps will be beneficial to the common man?
RBI has a limited leeway in checking the prices of commodities in the market. They do it through managing liquidity in the system, and they do it through signals on the interest rate expectations. That message has been clear that holdings, interest will not be allowed, funds will not be made available at cheaper rates. To that extent, the expectation could go down and somewhat prices may reduce, but basically on things like onions, vegetables, this depends on demand and supply. So as soon as the supply increases, the rates will stabilize.
Thank you very much. Thank you.
You were listening to a discussion on RBI's monetary policy. The participants were A.K. Gupta, Director, Bankers Training Institute, and Dr. Maharaj Krishan Bhatt, Principal, Maharaja Agrasen Institute of Management Studies. It came to you in the program News Analysis, produced and presented by the News Services Division of All India Radio. This program is also available on our website, newsonair.nic.in. You may email your opinion about this program at airnsdtalks@gmail.com.